Hi, JJ here with The Art of Value. Welcome. Well, today we're going to look at a recent interview with Stan Druckenmiller. He did an interview with a Norwegian investment management group, and it was about 17 minutes long, so I'm just going to provide some highlights, my favorite highlights of what Stan said. He's a famous macro investor, which is not something that I do, but he's famous for it, and he's done very, very well over the years. One of the greatest of all time investors, not just macro investor. He's never had a down year, has averaged about 30%. So let's get into the interview and see what he has to say about the current environment, current macro environment, what he's thinking for the time ahead. I'll put a link into the description of the actual interview, but Stan starts off saying that it's a very uncertain environment. In fact, he's never been as uncertain in his whole decades of investing, given that interest rates went to zero and they've gone up. He said 500 basis points since then. He said it was easier a couple of years ago to see what would happen from his point of view, but now he's pretty uncertain about his predictions about what he thinks is going to happen. So it's going to be interesting to see in the interview what he says he's doing at the moment. Okay, so next Stan says that he expects to see a hard landing. He still expects to see a hard landing in 2023. My previous video about Stan Druckenmiller, he said the same thing. He was expecting a recession, a hard landing recession in 2023. He's still expecting that. So in terms of what he's doing, he was asked how he is going to proceed, how he's going to navigate forward. He says that he doesn't really see a fat pitch coming from fixed income or from bonds. And he says he generally in a hard landing, he might do that, but he doesn't see a fat pitch. That's an expression that Charlie Munger and Warren Buffett also use. Like, you don't have to invest, you don't have to, unless you see a fat pitch to hit it. Relating it to baseball, you can just let the ball go by. You get as many strikes as you like, not just 3 strikes, so you don't have to strike until there's a fat pitch. And Stan isn't really seeing one. He says it's complicated, and if he was going to invest in those things, he said even though he thinks there's a hard landing, he'd better be right about it. He's okay about saying that he's wrong sometimes, admitting that he's wrong. He gets a lot of things wrong, but he's had an incredible record over time still. That's another thing about investing. As Monish Pabrai said, you can get many things wrong and still come out way ahead. He says part of his apprehension at the moment is what he saw with Silicon Valley Bank, the reaction to that they put so much money in there that it kind of wiped out what they'd done in the previous months in just 4 days. So he says that if inflation came back, if there was a hard landing, a hard recession, he's not sure what the Fed would do. He says that Jerome Powell isn't really a stickler for what he's doing. He's shown that he can pour money back in really quickly if he wants to, and he thinks that if there's a hard recession, that may happen, and which inflation would go back up. So he's not willing to make these big bets based on a prediction, and you know, it's so difficult to make predictions and invest based on it. People like Warren Buffett just say don't do that. He's an investor. Stan is an investor that does that. It's very difficult. He's done very well over time, but definitely not for the faint of heart and not recommended by anybody really, except a few people. There's only a handful of people in the world that can really do that successfully. Maybe George Soros, who he worked with, and Druckenmiller. He was asked what his thoughts are on stocks, on the stock market, and he said that if anything, because he sees a hard landing coming, he'd probably short something like the Russell 2000. He didn't say he was. He said that some old economy stuff in there he might short if there's a hard landing. He also mentioned that he's short the US dollar, and he admitted that he missed the run-up in the US dollar over the last 9 months or so, but now he's short the dollar. I think that's going to come to grief, and he also is long gold, both of those things. So he said that's the only area where his risk on is shorting the US dollar and long gold. So he was asked by the interviewer if he's mostly sitting in cash then, given that he thinks the securities, the equities situation is so complicated, and he did mention those things like gold and being short cash, being short the US dollar, but he said no, he's too much of a junkie to stay completely out of the market. And he said, but they said they're about 3% net short in equities, and then there's some that they like, but he obviously is pretty pessimistic about this hard landing situation. So sounds like he'd like to be in cash, but he always likes to be doing things, and that served him well over time, having never had a down year. He was asked about his investment record, about never having a down year and getting this 30% average over 30 years, which is pretty incredible. He said, well, it hasn't all been plain sailing, and it hasn't all been like 30% a year, of course. He He says the way that he has managed it is he's happy if it's 0 to 5 in the bad years, say going through tough market times. If it's 0 to 5% he gets, that's fine. It's just not negative. And then he might get a big one. He mentioned only swinging when you can see a fat pitch. So swinging big when you see something that's really worth investing in, really sure of it. He talks about that, and that's how he's done so well. Just getting low gains, but not negative, and then getting some huge gains in the good years, which has brought him up to that really good compounding rate. By the way, if you're watching on YouTube and getting value out of this episode, I'd really appreciate it if you hit that like button to help spread it to more people so more people can see it. Thanks. So he's asked about his investment strategy, his approach to investing, which is highly unusual for such a successful investor. As I said, very few people do this and are so successful at it. He was asked about whether it's gut feel or analysis, and he said George Soros told him, don't get analysis paralysis, it's invest and then analyze after that and pull out if the thesis was wrong. That's the way that he does it. So he gets this gut feeling about it, invests, and then he gets his analyst to analyze it, and if he turns out through analysis that it's wrong, then he'll just sell it. So he said he doesn't want to miss out on that 30-40% bump while they're analyzing it and it's going up. So it's very much kind of short-term investing this way, but he, as I said, he's been very successful at it. But certainly not recommended for anybody, but for a handful of people like Soros and him who've done so well out of it. He adds to that saying that his mentor was a chartist, so that's how he began. But nowadays he uses fundamentals and charts, doing both. I guess it's charts first and then to back it up with analysis, as he just explained. And those two things fit together. They both back each other up, those disciplines, he said. He was asked about how he's so good at questioning his own beliefs. He's kind of famous for changing his mind quickly. What he's saying today about how he's investing and the predictions for it, he said he might change his mind in a week. He's known for that. So when you see an interview like this, he could be doing something different the next day or the next week. So I certainly wouldn't copy what he's doing. But he says that he has young people working for him who are willing to debate him about things. He said if people just agree with him, yes people, then they don't really last very long there. He needs healthy debate. But he said he has these things. He has the price action and the news about stocks or whatever investment it is, and then fundamentals, those three things. And they obviously debate amongst themselves, but he can change his mind quickly or stick to his own beliefs if he thinks it's warranted. The interviewer asked him, how are we going to make money over the next 2 years? What's the best way he sees to make money over the next 2 years? Which is a pretty direct question. And he said that he said, oh boy, actually first, oh boy. About 8 months to a year ago, he said he gave an interview where he said that he wouldn't be surprised if in 10 years the stock market wasn't up from where it was then. And he said he still sticks by that. And I did a video about that. I did an episode about that when he did that interview. I remember talking about it. So I'll put a link to that at the end of this video and in the description to what he said back then. It's interesting to see the differences then to now. He's kind of sticking to his guns about this hard landing. Even though he said that he thought the stock market might not be up over the next 10 years, he said there might be some big ups and downs that can be taken advantage of for investors like him. Not predicting what's going to happen, just kind of wait and see and then swing big when there's a period. He said that one of the things might happen is that the Fed might react by pouring lots of money in, and that could spike the market, that sort of thing. So he's looking for periods like that, even though there's a longer period where it goes nowhere. There could be some big ups and downs along the way where investors like him can make a lot of money, as he has done in the past. He reiterates by saying he hasn't seen this movie before, this situation. People say, oh, I've seen this movie before, I've seen it play out, I know what's going to happen. He said he hasn't seen this before, so he hasn't got huge conviction on what's going to happen, so it's just like a wait and see. But he does say that he thinks there's going to be some amazing opportunities in the next year or so. In equities, he said it may be a big spike at some point, but not a big bull run, as I understand what he's saying, just taking opportunities where he sees them. So he ends the interview like that. And I find it's interesting to hear someone like Stan Druckenmiller, because it's a very different way to how I invest and most people invest. And as I said, it's very difficult. I wouldn't even attempt it to kind of predict the market. People say, don't try and predict the market. Warren Buffett says that. You do better over time by not predicting, just looking at fundamentals. He invests a very different way, and it's fascinating, but I would not swap to that kind of thing, even though it's, it's tempting to see take advantage of these short-term opportunities that he does by predicting what's going to happen or seeing what's going to happen. He's very good at observing what's going to happen, I think, not necessarily predicting it, but just observe what's happening and jumping on it and taking advantage of it for a short time and then changing his mind whenever he feels the need to do that. If you're watching on YouTube, I'm going to put a link to the previous Stan Druckenmiller interview I did a few months ago where he did talk in a similar way, and it's interesting to see the differences between then and now, so go and see that if you want to now. If you're watching on YouTube, I'll put it in the description for those who aren't on YouTube and listening on audio. Thanks for watching or listening, and I'll see you next time.